Hello and welcome to IMTV, the Industrial Minerals News Programme. Coming up today, fracking is once more welcomed by the UK government. US Advisory Council warns against stockpiling rare earths. And titanium dioxide price rises. Will they stick? Hydraulic fracturing or fracking, the practice used to extract natural oil and gas from underground shale wells, is soon expected to take off across Europe as regional governments begin to show political support for the unconventional energy source. In the UK, fracking has once again received backing from the government after Chancellor George Osborne repeated his pledge to support the industry in his 2013 budget speech. Confirming his intention to provide a new regime of tax allowances, originally mentioned last year in the autumn statement, Osborne also signalled support for communities where fracking will potentially take place.
I also want Britain to tap into new sources of low-cost energy like shale gas. So I am introducing a generous new tax regime, including a shale gas field allowance to promote early investment. And by the summer, new planning guidance will be available alongside specific proposals to allow local communities to benefit. Shale gas is part of the future and we will make it happen.
The fracking technique has proved extremely successful in the US, where more than 1 million wells have been drilled over a period of 60 years. In any case, Centrica, the owner of UK energy company British Gas, recently signed a 20-year agreement to secure natural gas supplies from the US, meaning that shale gas will, one way or another, be finding its way into UK homes. Further away from the UK, in Russia, Lukoil told Industrial Minerals that there are billions of tons of unconventional oil potential. The country has already seen some of its largest oil companies, including Lukoil, Rosneft and Gazprom Neft, launch projects in the Bazanhaf area. Lukoil explained to IM that successful unconventional oil extraction, such as that seen in the US, is most likely to be emulated in Russia. If you want to find out more about fracking in Europe, sign up for our Proppant Prospects for Europe roundtable on the 30th of April in London. US lobbying group, the Strategic Materials Advisory Council, has cautioned the country's Department of Defense to avoid stockpiling strategic and critical materials from China, labelling the approach a risky mitigation strategy. The warning follows on from a Department of Defense report which actually recommended stockpiling of $120.4 million worth of heavy rare earth elements, for which the country's sole supply source is China. The Council's Executive Director, Jeff Green, told reporters that the root cause of the material shortages was the ongoing dependence on Chinese suppliers and that the US should focus on the only appropriate and permanent solution, the creation and nurturing of a US-based rare earth supply chain. Rare earths exports from China reached 1,106 tonnes in February, up only slightly month on month from the 1,092 tonnes recorded in January, but an increase of around 289% year on year. The month-on-month increase runs contrary to the expected dip, which ordinarily occurs following the Chinese New Year, which took place on the 10th of February this year. Despite this increase, market sources maintain that overseas demand for rare earths has not improved since the economic downturn impacted rare earths ends market in 2012. Don't forget, China's Industrial Minerals and Markets New Horizons, New Mindsets is being held in Shanghai this year over the 23rd to the 25th of September. For more information, visit www.indmin.com/China Minerals. Despite the fact that many of the large titanium dioxide producers have announced price increases, analysts told Industrial Minerals that they believed these would not be accepted by end users. Cristal, Huntsman, ISK and Kronos have already raised their prices, leaving just DuPont and Tronox yet to take a position on for this year. Hassan Ahmed of Alembic Global Advisors told Industrial Minerals that while titanium dioxide prices have come down with a variety of non-integrated producers, he does not see the recently announced price hikes sticking in the near term. Managing Director and Senior Analyst at Wells Fargo Securities, Frank Mitch, agreed, telling Industrial Minerals that it is unlikely that the price increases will be accepted. According to Mitch, utilisation rates need to reach 85% to support price increases, a level unlikely to be reached until Q3 2013 at the earliest. The industry began a steep downturn in the second half of 2012, driven by end-user destocking, but it's believed that this is coming to an end. Ore costs, however, continue to squeeze pigment producers, which are trapped between these escalating costs and pressure from large end users to keep prices low. Australian mineral sand producer Iluka Resources released its annual results, which revealed the scale of flagging demand in the industry. Profit for the miner slipped 30% year-on-year, while revenue fell 21%. Chairman John Pizzey said that the decline in earnings represented the adverse impact on revenues from markedly lower sales volumes across all of the principal products. The impact of lower sales volumes was compounded by a decline in received prices in the latter part of 2012, he explained. This is telling because Iluka, as one of the world's largest producers, is in a position to advise the scale of the demand cliff. Despite this, the company remains upbeat for the year ahead, arguing that developing economies such as China are entering a period where economic growth will be comprised increasingly consumption rather than investment, which represents a positive trend for many applications for mineral sand products. And finally, the European Commission has launched a public consultation on so-called conflict minerals in a bid to gather views on a potential EU initiative for responsible sourcing of minerals from conflict zones and high-risk areas. By launching the consultation, the Commission aims to better understand the issues surrounding the sourcing and security of supply of minerals, supply chain transparency, and good governance from areas such as war zones, post-war zones, and areas vulnerable to political instability or civil unrest. The results of the consultation will be used to help decide how to continue these ongoing due diligence initiatives, as well as to create new governance in mineral mining, especially in countries affected by conflict. They will also be used in the formation of a discussion paper or communication later this year and for an impact assessment in support of a possible legislative proposal. The latest issue of Industrial Minerals can be found on our website, www.inmin.com, on the left-hand side. Simply click on the image of the magazine to read in-depth features and analysis. You can also find out more about corporate subscriptions, and if you're interested in advertising or sponsorship opportunities for IMTV, contact Benjamin Ash at bash@indmin.com or Ismen Clark at iclark@inmin.com. Well, that's all we have time for this week. If you have any comments or feedback, we'd love to hear from you. You can get in touch via Twitter @indmin or contact us through our website www.indmin.com. Thanks for watching and see you again soon.